and we'll start.
Great, fantastic. I thought there was going to be some kind of jingle or something like
Oh,
that.
I'm about to start it now. So everybody, welcome to Pickle Juice podcast. Really happy to have a mate of mine on today that I've known for almost over 10 years now, I have to say. And every episode that I've had on now, I've had somebody on that I know relatively well. There hasn't been any strangers just yet, and Dan's definitely not a stranger to me, that's for sure. But Daniel, myself and Daniel met back in 2014-ish when he was working with Emarsys. I was also working with Emarsys. Also, Dan happened to be the co-founder of Emarsys. And we worked together for a number of years, and since then we've kept in touch. Dan has been, since his time at Emarsys and exiting that company 2016-ish, has been working, helping companies grow and scale, right? Specifically in the e-commerce space, so tech into e-commerce and commerce, but also not just in e-commerce, but that's where a lot of his experience comes from, especially with Emarsys. Also has been working with a few ventures. So, for example, i5 Invest, right? He's a partner there, has been helping companies grow, helping founders there understand the market, helping them get to the next level in their scaling, right? On top of that, he's also a venture capitalist. So Dan as well also pumps some of his own hard-earned money into helping other companies grow as well. And before he started doing that, Dan had a full head of hair. Would you believe? No, I'm joking. But yeah. But Daniel, really happy to have you on, mate. And yeah, how are things?
Great, fantastic. Thanks for remembering me. It's been a few years now. I think I blame that on kids though. You know, it's when you have teenage boys, that's what the hair loss is going to be. Not so much the work, but life's been good.
Yeah, man. So my wife always tells me, my wife and daughter both tell me daily almost how grey I'm getting, and it's definitely to do with kids and work. I can 100% correlate those two things to like more and more like silver coming into the side of my head here. That's for sure.
Bit of salt and pepper.
Yeah, absolutely. Absolutely refined is how I'm starting to look now, you know. That's the point.
Yes, refined.
So tell us, how are things going across all of your different ventures and that? You're doing quite a bit.
Yes, just like jack of all trades, master of none, really, sort of that kind of thing. Same thing with sports. I do triathlons because I couldn't commit to one sport. I'm not really good at cycling, not really good at running, not really good at swimming, but just, put three sports together. Why not? On the one hand, I'm a partner at a mergers and acquisitions boutique and corporate advisory, which is i5 Invest. We're now over 100 people globally with offices in San Francisco, European HQ in Vienna, and have a few offices as well, but now over 100 people. I'm doing about 20 odd transactions a year. It's going pretty well. I think the market is slowly recovering from probably some of the worst M&A and investment years in history, the last two. So 23, 22, 23, and sort of like the beginning of 24 probably were not ideal if you were an investment banker or trying to raise capital. Still is great, but I don't think it will ever get to that point where it was the crazy years, the lunatic years of 2019 to 21. Those were just absolutely crazy. But we're getting back in terms of decent valuations for companies. The VC game is not there yet because it's very hard to raise capital at this stage. Early stage is easy, but if you're looking at maybe Series C, Series A, and if you don't have amazing metrics, it's going to be extremely hard for companies to raise capital at the moment.
Yeah, I mean, the thing is about those, like the 2020 years, right? Let's call it those, when everybody was getting cash and there was money floating around like it was going out of fashion, right? That's like, that wasn't the norm. Like that was an explosion and then it's gone back down to where it was before, right? Or has it dipped even below than it was before.
No, it has gotten back to a norm where it was before in like I would say almost a decade prior to that, when people still were looking uh, at reasonable growth. Then still what has changed though is that even before like a decade before, the focus of profitability wasn't there. So you could burn a lot of cash and still be able to raise good sums of money. But nowadays, people are looking and focusing more on, hey, is there sort of what's your path to profitability look like? We don't want to invest in a company that doesn't have any sort of sense when they're going to hit profitability and how they're going to do it.
Which I guess is sensible, right? Like that's the that's the difference. Like,
It's what we learned in college. It's what we still learned in university, you know, like profitability, etc. But then came the silly years, the first 20 years of 2000 were just from one silliness to the next. And even though you had a few market crashes in between, hello Lehman Brothers, uh, that, you know, people were so addicted to the rush of free money and that sort of crazy valuations that they tried, despite the recent crash, tried to get back into it as quickly as possible. You had the subprime mortgage scandal, but then people went. But did we learn out of everything? Did we really police banks more since then? Not necessarily. And now you have a system that is addicted to fast cash, and it's only a question of when they're trying to get back into that same sort of frenzy, I would call it. But you have now different forces working against it. You have it for private equities and venture capitals have extremely more difficult times raising funds from their limited partners. Therefore, new funds are slower to launch, maybe smaller amounts than before. And so for the foreseeable future, because the underlying capital givers to the frenzy have started sort of pushing back a little bit and not, okay, we're not just going to throw everything that we have into this money burning machine, where it's just the next unicorn, just next unicorn, next unicorn. Now we're just probably going to invest in things that are a little bit more stable, given the market conditions. Because you look around us, you know, you might think the world's gone down the drain the next week. There's a few wars, Corona's rearing its head occasionally again. You know, you have a stock market that goes up and then down and up and then down, that reacts to one job loss report with a 10% decline. Um, it's nothing that we've seen in terms that before in terms of market jitteriness, and therefore the underlying capital is not being deployed as it was before.
yeah, it's
So
a
maybe
very
that's a good sign.
yeah, maybe. Maybe I think it's very sensible, right? I think the way that it's being worked nowadays, it's not burn cash at any cost, and let's worry purely about logo acquisition in the tech space. Like, you know, I've been in the position before. Like when I was working with Emarsys, it was like, here's 60 million, go get some logos. Don't worry about how much you need to spend, right? Like spending to a certain and then until you need to worry about how much you're spending, right? So there is, but the sentiment more so from the market was like it's okay to burn cash and have somewhat control over it, but you can go a little bit wild and have a bit of a wildfire when it comes to cash, right? Nowadays, it's like let's be really sensible about where we're putting that cash, and let's stay on top of our burn. And even like series, I've worked with some Series C company last year or into this year as well. They'd raised a lot of capital, but they were even after raising over 100 mil. They were like, okay, now we need to cull costs. We need to just like make sure that we're going towards profitability after they've already raised 100 mil. You know, so they were focused purely on going profitable, right? Which was unheard of. Like
No, you go from one series to the next series. You go from series
Absolutely.
A through F.
Yeah, and
That
then
was your
IPO,
roadmap.
then
Yeah.
IPO. So like, so it's like the landscape has changed, but it's I don't know. I think it's for the better, to be honest with you. Any company that I've worked with that has had that mentality of burn, 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 it's like that gets into the culture a little bit, right? Which then, like, I don't know, it gets into the culture of the organization, and you see very quick turnaround of people. You see everybody's just looking for the next quick buck. They're not building anything sustainable. There's no like feeling of building something that's here for the future. And that's been my experience with working with people that are companies that are bootstrapped versus companies that have gotten a huge amount of funding, right?
The bootstrap companies are laughing. I mean, they were laughing, and from an investor perspective or acquisition perspective, those are the hot tickets at the moment. Any bootstrap companies that are in a few million ARR range, um, they get bombarded with inbound requests because they're profitable, they're growing nicely, um, and then with sort of money from an investor or growth or private equity, they can scale a functioning business model
Yeah.
even more.
Yeah.
And that's what we're at the end of the day trying to achieve. We're trying to get to profitable, sustainable business model that when you then raise capital, you can use that capital for scaling that already good working machine, underlying machine. But you build a house of cards on just how do we scale quickly. We're not really focusing on culture. How do we really integrate? If we have to add 60 new people every month to satisfy the growth requirements of our new investor or recent round leading investor, we don't really have time to hire for sustainability and hire for culture. And then you get to these house of cards that when the money dries out over the last 2 years, that we've seen so many people um, either cut costs dramatically and have to lay off a lot of people, or they were just lucky enough to raise previously big amounts of money that then this is kind of like, okay, let's just somehow keep that money without spending too much new and try to get profitability as quickly as possible. But some of them, they weren't built for that. And so they, at some point, they say, you know what, we just give up because the whole system falls apart.
Yeah. It's building something off a business model that doesn't make any sense. Like growth at all costs. I mean, that's like it's ignoring the fundamentals of business. The fundamentals of business is to create a profit. If you're spending more than you make, you can't. Like that's not sustainable, right? But
The
like that,
fundamental of business was to raise the next round.
yeah,
That was for the last few
exactly.
years. That was like, what are the KPIs that we need to achieve for the next funding round?
Yeah,
And we'll focus everything to improve those KPIs, not necessarily the underlying quality of the business, listening to the customers, improving things, making sure that we have a sustainable base to grow from, and we add to that base with every new iteration. But no, KPIs for next funding round are X, Y, Z. Let's throw money at it.
and you're handing off the baton from one round of investors to the next, and then
Basically,
basically it's inevitable somebody's going to be at the end of that line, series whatever Z, right? Series Z takes over, spends the money, gets and then very quickly a change in the market happens, and everybody else has managed to make their money, whereas whoever's invested in Series X, Y, Z, whatever it might be, is left there with a baton in their hands and not much else, right? And
that's pretty much the case. I mean, I'm talking against my own sort of industry here, but I'm I'm an investor, not necessarily VC, but I do angel and pre-seed, sort of that's sort of my stage, and sometimes first money. I mean, you introduced me to one of my first investments, actually,
I did,
Valaris, amazing company.
I did.
Thank you for that.
You're welcome.
Uh, but I see myself not in sort of that same shoe. I want to invest in companies that I can also add value to,
Of course.
not just be dumb money, um, just basically an investor that gives money and then has no value add. But most of the investors, I would say 99% are dumb money. Even on the VC stage or the later stage, they promise you the world with all their network and everything. But the moment that the investment agreement is signed, they put a banker on your board that knows really shit about your industry, and they just demand the KPIs of being achieved. But what they really need to do is, if you're a smart investor, most smart investors are former entrepreneurs because they know what it takes to build a business. If you were to raise capital now, I would always say to companies, go to to a fund that was founded by former entrepreneurs in your space, ideally. If not just in former entrepreneurs in general, because they understand what it is, what it takes to raise capital on the one hand, but also then operational challenges of a company. The people that they would put on the board as part of the investment agreement would basically be people who understand your space rather than finance people that just understand KPIs. And nowadays, most scale-ups that have a few rounds of investments, if you look at their boards, most of them are finance guys or bankers.
Yeah, that's a fair point. That's a very good point. I mean, that also as well, I think is where it plays into what you're doing as well. Like you're an early stage investor, right? So pre-money, angel investor, and it's like you've got that entrepreneurial experience as well. So you know the struggle that a founder might find themselves in trying to grow. But you're also trying to get that money back as well, right? So it's also in your interest, right, to really give access to your network to help them grow, right? Because it's investing in yourself as well, right?
Well, that's the whole point. You know, if you invest in a company, you should be investing in companies that you A, have a passion for, or B, understand the background and the ecosystem that they play in. Because then you can add value, both from your passion for the topic that they're dealing with and networking on their behalf, but also with your network that you've built through your own career in the ecosystem that your investments play in. And that is I think the right kind of investment that companies should be looking for. Because it's easy. Well, if you are struggling to raise capital, at some point you're just going to, and especially in a situation like today, where a lot of founders who want or need to raise capital, they'll basically accept any check that comes their way because it's so hard. They can't really be picky and choosy anymore. Not like it was a few years back. And so you're adding investors to your cap table and to your board that that might actually do more harm to the company from the medium to long term than that immediate check that they're cutting you and that allow you to scale a little bit more.
That's a fair point. Fair point. Okay, I'm going to change tracks quickly because we only have a couple more minutes left. I want to get into Emarsys and how you founded Emarsys because this is a funny. I like this story. Right? So and I also want to hear about the story about the flagship customer, the signing of the flagship customer. Now, just to give people of a flagship customer, eBay, that first flagship customer story, right?
We didn't want the flagship customer.
Yeah,
we didn't want it.
You got it, though. You got it. And just so people know, Emarsys was acquired by SAP, what, 3 years ago?
No, 2020.
2020, so
November 2020, yeah.
Almost exactly 4 years ago.
So when I sat down 2016, that was after the big expansion to the US. And I'm the type of person that always need a carrot in front of me to get motivated for work. And at that point, we had no immediate carrot left to tackle. So it was like, oh, we'll do an IPO at some point and or we'll sell at some point. But there was nothing, no big markets left to tackle. And so I stepped down, I retained my shares. So the exit actually happened then when SAP acquired us for 100%, which is a great deal. But so when we founded Emarsys, actually Hagai, my co-founder and I, we started a different company before, an online insurance comparison website straight out of uni, Webster University in Vienna. And we launched that just at the time when the dot-com crash of 2000 hit. And so we were left there with like a beautiful interface and a good business model that was going to make cash, but nobody wanted to touch our business because it was an online business. And so we closed it down, and then we got to know our essentially Emarsys co-founding investor, Mr. Ahorner, Joseph Ahorner. He's a member of the Porsche PX family. He had this internet consulting company group of things, because in the early 2000s, internet consulting companies were all the rage. They were doing everything. They were doing software, they were doing consulting, marketing, everything. And so he took a pity on us and said, you're smart guys, come work for me as project leads. And as one of the projects, it was basically to define for online branded games how you can capture people and then re-engage with those people that come to a website and play a branded online game. And that led us in the research to the book Permission Marketing by Seth Godin. And from that on to technologies that existed at that point really in the US, or were big in the US, email marketing. And from there, not just email marketing, but back then it was called application service providing. Now we call it cloud, SaaS technologies, not licensed on-prem solutions. And then we saw like, this is bigger than just a project for a branded online game. And we basically pitched Joseph Ahorner the idea that actually what we should be doing is creating a tech company that does web-based email marketing software, but built not for techies by techies, but built for marketers by marketers. I studied marketing in uni. Hagai is a finance major, and we had no idea about tech, but we knew that there was a disconnect between what a tech-founded solution was that's being used by marketers, because they don't speak the same. They couldn't speak marketing speak and tech speak. We're two languages in the three-dimensional world that never met. And so we wanted to create something that from a usability, from a UX, was able to be used by the most stupid marketing assistant at that stage. And that stage meant a lot of things, because back then we didn't know HTML. Nobody in marketing understood SQL query statements. So we needed to create a visual interface that you could create interactive, personalized emails without having to understand HTML or a single line of code.
I mean,
that was the founding story.
That was the founding story, and that founding story started in Vienna in the year 2000, right?
Yes, exactly. And we had our first customer was May 2001, because we went out to the market with a series of free webinars and seminars, because nobody understood email marketing. They knew Lotus Notes and Outlook. Nobody understood back then the concept of a web-based solution that you pay subscription for, not just a one-off license. So we needed to convince the market and then sort of build the market, educate the market about those two concepts. And so we held just for a few months, we held weekly, a few times a week, seminars and webinars, and invited people for free to attend those. And we generated our first customers out of that series of events. And at the time when I left 2016, we still had those customers. It was Zurich Insurance and Canon were two of the first customers.
Interesting. That is one hell of a lifetime value, by the way, on those.
Yeah.
16 years.
16 years later.
Jesus Christ.
Yeah, 16 years later.
Yeah. Interesting. It's a sticky product. But, let's say once you're in, you're not leaving. I'm joking.
But we had, when we were forced to scale, I think it was 2005, 2006, eBay Germany approached us because we were pitching a lot in sort of content marketing. We talked a lot about deliverability, which was a huge topic back then. How to get emails into the inbox. How do you avoid spam filters and get blocked by blacklists, etc.? How do you configure your servers? How do you optimize your emails so they actually show up not in the spam filter in the inbox of the intended recipient. And so we put a lot of research into that. We had a good team that managed all of that. And that sort of caught the eye of eBay Germany, which was at that point, I think, the second or third largest market for eBay worldwide. And they had huge deliverability issues. And so they approached us and say, we'd like to work with you. We said, no, we can't serve you. But they were kind of insistent. No, we do want to work with you. Say, no, we don't want to work with you. You're too big. Go to somewhere else. Go to the big Americans. I'm sure they're better. No, we work with a big American. We want you. You talk deliverability. They have no idea about deliverability, at least back then. And so at the end of the day, we said, okay, we have to build a completely new platform for scale for eBay. And so we decided, all right, if you're willing to fund that development into, because we built our platform for SMBs, mid-sized European companies, not for companies sending millions and millions of email every week or day and millions of data records. We didn't know how to do that. And so we had to completely change our system architecture for that. But eBay was willing to finance that. And then we landed eBay Germany out of that. And then eBay Worldwide pitched. And because we were the provider of eBay Germany, we were invited, obviously, to take part in that. And we won the global contract for eBay against all the major players back then, ExactTarget, Cheetah Mail, or they're called Experian, Cheetah Mail already, I don't know. Everybody else who was big at that point lost out against this group of, we were 35 people.
I was going to ask you how many
small
people? Yeah.
Australian company. Who? What? It's like, what? Wait, what? Where's that? Where did it come from?
That's hilarious. Two men and
yeah,
their
that
dog
was
just
crazy.
showing up, for a pitch, Two men and their dog and a dream,
We were scared shitless. We
Yeah.
did, honestly, we thought we'd bitten off more than we can chew, and but it really forced us to become bigger international. We saw also at that point, up until that point, we were basically bootstrapped. We didn't sort of raise external capital or didn't expand because we were too conscious of the marketing power and the sales power of sort of the big American players, international players. And the win of eBay sort of changed something in our minds that, we say we can beat the biggest players in the market. And from that point on, we started scaling.
It's amazing. That's amazing. I love that story, man. And I'm going to finish on that story because I love hearing it every time. And I think that's a great way to finish up. Dan, thanks a million, mate. It's been a real pleasure again. And
thanks for having me.
Yeah, no worries. And look, if people were to find you, where's the best place to get you, Dan?
LinkedIn. Just find me in LinkedIn. Best place.
I'll make sure that your details are shared in the description. And Daniel, massive thanks again, mate. Much appreciated, yeah?
Andy, have a good one. Take care.
Thanks.
Talk soon.
Guys, this has been another episode of The Pickle Juice. Tune in again next week for more great content. Thanks, Dan.